Hey everybody, welcome back to Whiteboard Finance. My name is Marco and I'm here to help you master your money and build your wealth. In today's video, we're going to be breaking down Paul Merriman's ultimate buy and hold portfolio, which according to his statistics have absolutely crushed the S&P 500 over the past 50 years or so, which I'll show you here shortly in this video. So in this video, I'll briefly explain who Paul Merriman is, not Paul Perriman, dissect his ultimate buy and hold portfolio strategy, and also give my thoughts at the end. Stay tuned. Okay, so who is Paul Merriman and what are the bullet point takeaways of this portfolio thesis? So Paul Merriman is a retired financial advisor and author who has a somewhat cult-like following online. He has a nonprofit called the Merriman Financial Education Foundation where he helps educate children and investors on most matters within investing. I'll be honest, I haven't really followed his career or his work, but a lot of people who I respect have cited his ultimate buy and hold portfolio, so that's why I'm dedicating an entire video to it to share with you. So what are some quick takeaways of the ultimate buy and hold portfolio? So Paul states that the S&P 500 can easily be beaten without taking on much more risk. He also states that the impact of adding just 10% of another asset class can improve long-term returns. He also says that the impacts of even 0.1% of annualized returns can be life-changing over long periods of time, which I'll show you later in this video. Diversification of equity classes or asset classes, is just as important as the diversification of individual stocks, and also adding international stocks can have a meaningful impact on long-term returns, whether you add 30% or 50% of the portfolio dedicated to that. So this portfolio isn't designed to get the best return, but it is designed to get a better return than the S&P 500 without substantially more risk. Okay, so this portfolio sounds way too good to be true, so let's dig into it. Okay, so digging into the portfolio, as we mentioned, he likes to have exposure to international stocks. So for this example, we're going to use his 50-50 data. So 50% of equities in this portfolio will be from United States equities. The other half will be from international, and we'll see how he breaks this down. I'm first going to explain all of the different asset classes that are within this portfolio, show you his recommended ETFs, and then we'll dig into his data and numbers and how this beats the S&P 500 over the long run according to him. So first we have the S&P 500, then we have US large cap value, then we have United States small cap blend, United States small cap value, REITs, which are real estate investment trusts, international large cap blend, international large cap value, international small cap blend, international small cap value, and emerging markets. So as you can see from this crudely drawn pie, each one of these slices is 10%. There's 10 total slices. So they each have 10% equity class as being part of this portfolio, equaling 100% of a pie, if that makes sense. So if he were to include bonds in this portfolio, because remember, this is all stocks right now, it would just be create 8% of each position. So 8 times 10 equals 80%. And then you allocate the other 20% to bonds if you're shooting for an 80-20 portfolio, for example. So let's take a look at an example of an ETF that would cover all of the asset classes within this portfolio, so you can consider this to your own portfolio once you actually see this data. So the S&P 500 would be Vanguard's VOO, large cap value would be Invesco's RPV, US small cap blend would be iShares' IJR, US small cap value would be Avantis' AVUV, REITs would be Vanguard's VNQ, international large cap blend would be Fidelity's FIVA, international small cap blend would be Schwab's FNDC, international small cap value would be Avantis' AVDV, and then for emerging markets, you can use Avantis' AVEM. So those are all ticker symbols. So you can see that he loves Vanguard and Avantis sprinkled in with some iShares. I personally hold a lot of Vanguard and Avantis funds myself, so maybe we're both on the right track here. Now that you have a better understanding of what funds to analyze before we get into the data, I'm interested to see what your thoughts are about this portfolio in the comments below. Just pause the video, if you want, take a look at this and let me know if this is something that you would hold in your own portfolio. So if you're looking to diversify your portfolio even further away from equities and real estate, check out this word from today's sponsor, Masterworks. Knowing where to invest is a question on everyone's mind right now. After all, there have been days this year where 99% of stocks have lost their value. Of course, any single day doesn't make the market, and stocks are long-term investments, but we're all thinking, hey, I'm diversified. Why is my portfolio still getting wrecked? Well, Goldman Sachs has released a shocking report saying that the classic 60-40 stock to bond strategy won't be enough to keep investors afloat. It's down anywhere from 15 to 25% this year alone. As a result, Goldman says the ideal allocation for stocks has shrunk from 60% to roughly 45%. So what do they recommend you do with that difference in order to salvage your returns? Well, you can invest in real assets like fine art. I know it's surprising, but Goldman Sachs says fine art can protect your purchasing power even in the face of rising prices. According to the New York Times, during the last period of rampant inflation, the ART 100 index outpaced that at 130% appreciation versus 80% price increases. Most people don't realize that art can be a financial asset. Even since my first video with Masterworks just this last month, Masterworks sold a painting for a 13.9% net return. See, Masterworks qualifies their paintings with the SEC, turning legendary art into an actual investment for a fraction of the full price. I've linked to all their offerings in the description. Please feel free to learn more about their Register A filings below. Masterworks' last 3 exits delivered 13, 17, and 21% net returns. With over 600,000 members, Masterworks paintings have sold out in minutes, but you'll get priority access just by clicking the link in the description below. Okay, thanks for sitting through that spot from Masterworks. These sponsorships allow me to keep creating content and providing value to you for free. So now that we have an understanding of his philosophy and also the holdings within his portfolio, let's take a look at the numbers. The easiest way to show you this is to leave this screenshot up on the screen while I explain this. So let's start from the top. This is the ultimate buy and hold equity portfolio made up of 50% US stocks, 50% international stocks. So if you look at the header up top, you can see that there are 7 different portfolios here. You can see that we start with the S&P 500 and we work our way all the way down to emerging markets that include 10% of everything we just talked about. So the time frame we're looking at is from 1970 to 2021, which is roughly 52 years with annual rebalancing. We're starting with $100,000 on day 1, and you can see the annualized compound return. You can see the annualized standard deviation, meaning how much the portfolio has deviated, and you can see the difference from portfolio 1, which again is just investing in the S&P 500. So as we move along down the chart, you can see the different results for yourself, but if you go all the way to the ultimate buy and hold portfolio, which is portfolio number 7, here at the end, you can see that this $100,000 after 52 years with annual rebalancing grew to $47.7 million, which is a 12.6% compound annualized return. This is a $24.6 million difference, more than if you just plopped that $100,000 into the S&P 500 in 1970. So let me stop right here. Obviously, these numbers are compelling, but I do have to play devil's advocate. Anyone can cherry pick specific years to give them the best return or make it look like their strategy is the best. But what I will say though is that he's keeping this as current as possible. So in the bottom right-hand side of the screen, you can see that this table was actually exported on January 29th of 2022, meaning that it's about a year old at this point. However, it also means that it's pretty up to date, and they didn't stop it in 2006, for example, right before the great financial crisis, or January, February of 2020, right before the huge March 2020 dip. So I'm interested to see what these numbers come back with over the past few months with a new edition. So we'll see what that looks like, but I can't do that video until probably January or February of next year. So I took it upon myself to go to portfoliovisualizer.com, and I basically recreated his portfolio, and I had to substitute a couple of the Avantis funds just because they were limiting the time frame that we can go back and analyze this. But I basically compared his portfolio to the S&P 500, and you can see the results right here at the time of this recording. The S&P 500 absolutely crushed this portfolio since January of 2014, December of 2013. You can see the ending balance with $10,000 invested is almost $17,000 for the ultimate buy and hold portfolio, and it's $26,000 for just investing 100% into the S&P 500 fund, which in this case, I just used Vanguard's VOO. So not only that, but the max drawdown of the ultimate buy and hold portfolio was 27.45%, while the max drawdown for just the S&P 500 VOO since January of 2014 was almost 24%. So another scary metric is the Sharpe ratio, which is significantly lower at 0.41 versus 0.73. If you don't know what a Sharpe ratio is, it's basically one of the most widely used methods for measuring risk-adjusted relative returns. So the higher the number, the better. This is not a good look for the ultimate buy and hold portfolio during this time frame, in my opinion. Again, the higher a fund's Sharpe ratio is, the better a fund's returns have to be, or better they have been relative to the risk it has taken on. So let's get into my thoughts at the end of this video, because I do want to give this a fair shake. Okay, thank you for sitting through that. Just to give him a fair shake, that is a limited time frame. So again, that chart went back to like December of 2013, January of 2014. Obviously, that's only roughly 8 or 9 years, okay? So what I'm trying to say is, yes, his data goes back 50 years, but I'd also have to take a deeper look into his numbers. I need to know where he's getting his numbers from. I wasn't able in Portfolio Visualizer to go back that far, just because if you include every single fund, those 10 funds that I talked about, there's gonna be one of them that trips up the backdating. So you can only go so far back as to when that fund was created. So I subbed out a couple funds just to make it go back to 2014 or 2013, but you know, it would be nice if I can go back a little bit further, but there's just so many of those ETFs that, again, the time frame is limited. So I'm not saying I don't believe him or anything like that. I'm sure his numbers are true or correct, but you know, it'd be nice to actually see it for myself. Then also, I think for most people watching this video, I think the 3-fund portfolio mixed with maybe some dividends is probably gonna be your best bet. If you're not familiar with the 3-fund portfolio, search my channel. I've done a couple of videos on it. Basically, it's 3 ETFs or 3 mutual funds. Basically, it's you can do Vanguard's BND for bonds, you can do VXUS for international, and you can do something like a VTI for total broad market exposure. So I think for most people watching this video, that's gonna be the easiest way to invest. However, if you like some perceived diversification and if you want more international exposure, again, you can check out Paul Merriman's Ultimate Buy and Hold portfolio. So I hope I did him justice. I hope I did this video justice. Again, thanks for sitting through the sponsorship. That's how I pay the bills and allow me to create this content for free. So as always, thank you so much for watching. Please hit the like button, share the video, and subscribe. And as always, have a prosperous day. Okay, so I'm not gonna lie, I don't have the creative juices in me today to think of something funny. For the end of the video, I've been trying to toss around ideas like Merriman, Buy and Hold, 3-fund, international, all that stuff. I can't put it together today, you guys. If you have a funny video or a funny outro for this video, leave it in the comment down below. Thanks.